My fellow investors, welcome back to the Newcomer Investor Channel, where we talk about great businesses and make investing accessible and fun for everyone. I'm your host, Anthony, and today I am so excited to welcome an incredible guest, one of my favorite people in the FinTwit space, who I am so happy to finally get a chance to sit down with and chat with. And his guest is Nelson. Nelson, thank you for being here today. How are you doing?
I am great. Thank you for inviting me on. I'm excited to talk stocks.
Perfect. Now, to get us started, actually, before we even get started, I do have to remind everyone that nothing we say here is financial advice. We're not here to tell you what to do. We're just telling you what we do. But we're always continuously learning, so always do your own research. With that said, before we get started into the stocks, Nelson, I'd love to get a little introduction from you. So if you can tell us a bit about who you are, where you're from, your career experience, and just, yeah, a little bit about your life.
Sure. So I grew up in a small town in Alberta where my parents, my dad especially, he was a real estate investor for as long as I remember. And one day I was about 15 and my dad broke his leg actually fixing up one of his rental properties. He's swapping out a light and his ladder from about 1952 broke underneath his weight and he broke his leg. So he was out of work for several months. And during that time, I kind of asked him some questions because I was a little bit curious about the investing thing. But mostly, I just wanted to make sure that my family could afford to eat while he was injured. And he said, "Don't worry about it. We have these houses that I've been invested in for years and years. And for me, those were always just this annoying place I had to go after supper to help, cut the grass or clean up after a tenant or whatever." And he said, "No, these houses will keep us going while I'm not working." And for me, that was just kind of this amazing statement because it's like, well, how does this work? And so he had the time and he really taught me the basics. And from there, it just kind of, for me, the interest just snowballed. I bought my first property when I was 18, actually. And very quick story there is my dad just said, "Hey, there's this house for sale. You should buy it. If you don't buy it, I will." And that was good enough for me. So that's how I bought my first property. And then I bought a couple more after that, and then kind of the bug was there, and I've been an investor really ever since. And for me, working was just a way to generate capital that I could invest. So I spent most of my career in the grocery business. I started working at the local store where I grew up, and then I eventually moved up, and I ended up working at the head office where I did that for a few years. And then I was 39 and I had saved and I invested to the point where I was financially independent. So that was it. I pulled the plug at that point.
That's very inspiring. That to me, this is one of the coolest thing about your story is that it's authentic, right? Like a lot of people on the platform, kind of like finance influencers and saying, this is how you build your roads to riches, but they haven't necessarily done it, but you literally have done it and, living off the dividends and stuff. So yeah, super inspiring stuff. I love it.
Yeah, that's it. When I talk to people and I tell them, it's like, yeah, I live on my investments and I live on the dividends. It's always that, hey, wow, that's really, really good for you, whatever. And everyone just wants to talk about that, and nobody wants to talk about the 20 years that I worked, closer to
Mm.
25 years, really, if you include when I worked in high school, about how I saved 50% plus of my income for 25 years. Nobody wants to talk about that. They just want to talk about the fun stuff that happens after you do that.
Yeah, but you got to go for the work first to get to the fun stuff. Now,
That's right.
moving on to some of these, even before the stocks, but just a little bit about your investing style. Tell us, I guess, a little bit about how you view your portfolio. What's your main type of strategy with that?
Sure. So I am I call myself a hardcore dividend investor to the point where if it doesn't pay a dividend, I don't own it. I'm not interested in the high flying growth stocks. It's nothing against people who want to buy those types of stocks. It's just, hey, that's not for me. What I'm looking for and how I invest is I want boring companies that generate lots of predictable cash flow and that pay me, the owner of that company, a dividend out of that cash flow. So basically, it's a very business-like approach to investing. I approach it as I'm taking a long-term position in a business that I want, and in exchange, I expect that business to pay me a portion of the profits every quarter, every month, whenever they've agreed to.
It's almost like a rental property, basically. Is that, do you think, where you got that from? Is like you started?
It could very well be like,
Yeah.
the power of owning rental properties is that every month, for the most part, sometimes you run into trouble with the tenants, but for the most part, the rent is there every single month, and you can take that rent and, of course, put it onto your mortgage. And after a while, the mortgage gets paid off, and that rent is yours. And that's the beauty of it is you take that rent and you reinvest it and you reinvest it, and that gets the compounding going. That's the snowball, and the snowball keeps rolling and rolling, and then one day it becomes big enough that you don't have to work anymore.
Yeah, it's a virtuous circle. Okay, let's move on to now the really exciting part. Although all this was exciting too, I want to really pick your brains throughout this whole time that we have together on some stocks, especially. Let's start with the one that's been the talk of the town, TD. So as everyone knows, I'll just sum up quickly for our listeners. TD has been kind of involved in this kind of money laundering scandal. It was in the US part of the business, right? And now they finally got, I guess, the result from the regulators. They're going to get a $3 billion fine, as well as an asset cap on their retail business in the US, right? So some people have sold, some people have bought more, some people have done nothing. Nelson, I'd love to get your opinion on, firstly, what are you doing with it? And just how do you view this whole issue? And how do you think this even came to that at TD? How did they get there?
Well, yeah, so it's a very controversial issue right now. There are a lot of strong feelings. One of the things I really like about Twitter, there's two things I like about Twitter, and one is getting to interact with like-minded people like yourself and like a lot of the other people I invest with or that I interact with. But two is what I really like about it is I get to gauge investor sentiment. And that's an incredibly valuable thing on Twitter because you get to see what everyone's freaking out about, what everyone likes. And my general sort of strategy is to fade Twitter. So that means that if Twitter hates something, I'm interested. If Twitter loves something, then I'm a little bit more, like I don't necessarily hate it, but I
skeptical,
go into more cautiously.
Yeah.
And so with TD, it seemed like most everyone on Twitter was, hey, this is a really bad thing. I'm selling, I'm out. And you saw that with the price. The price went down the day that this was announced, and then it continued to go down. I think it finally, just today, was the first time that TD didn't have a kind of a big move downwards. So this is a negative, obviously, for TD. But I'm holding, and I don't think it's as huge of a negative as what everyone thinks it is. So you mentioned there's this asset cap in the US retail business. So TD is essentially 5 different banks in one. One is Canadian personal commercial banking. 2 is Canadian insurance and wealth management. 3 is the US retail division. 4 is the US commercial banking division. And 5 is capital markets. So you have one part of 5 that is structurally impaired for a little while. And the impairment is that there's a cap. It can only grow up to a certain asset point, and then that's it. So that part of the business is impaired. We don't like that part of the business right now. But there are 4 other parts of the business that are performing just fine. And I looked at the numbers and I looked at the history, and TD's Canadian growth has been higher than its US growth over the last 20 years, meaning that I think TD still has potential to grow inside of Canada. I think it has potential to grow the insurance and wealth management businesses. And I think that it has potential to grow the US commercial banking business. So you put all those together, and there's still growth potential for TD. It's not as much as what there was before, but the growth potential is still there. And so you combine that with kind of how unloved the stock is right now, and I don't think the situation is so bad.
it's not something that they won't recover from eventually, is what you're saying, right? Basically, right? Yeah.
That's it.
Yeah.
And I mean, the one of the things about I mentioned fading Twitter and everything like that is the average Twitter user probably looks 3 months, 6 months in, kind of like that's their investment timeline. That's as far as they're looking. They're looking to the next quarter, the next quarter after that. I like to take a kind of like a 5 year view. And in the 5 year view, it's like, again, like I don't want to sugarcoat it. This thing, US retail banking thing, is bad. It's just, I don't think it's as bad as what the knee jerk reaction says.
Yeah, yeah. And there's always opportunity when people overreact to something.
That's it.
What do you think of the appointment of the new CEO?
I don't know that much about the new CEO, but the message that TD had to send to the market was, hey, we know the old guy screwed up and it's time for him to go away. And by doing that, I think that is kind of 80% of the 80% of the solution is getting rid of the old guy. And then we've got the other 20% is the new guy going to be any good? And I don't know enough about the new guy to be able to say, hey, he's the best. All I know is that getting rid of the old guy was a positive, and he'll retire with a great big pension, and life won't be so bad for him. But I think the stock went up 4% or something the day that they announced the old CEO had retired. And can you imagine putting? He was like a 20-year TD veteran, putting your entire life into a company and then have the stock go up 4% on the day that you announce your retirement. That's probably not a very good feeling.
Yeah, but I'm sure he'll be okay in the long run. I found
financially he sure will be.
Yeah, I found the new pick quite surprising in a good way. Like I'm slightly bullish on it. I feel like the fact that they brought he's not an outsider. He's within TD, but he's not like the traditional CFO who becomes CEO type of thing. I like that. It's kind of like a bit of an underdog vibe, but in a good way. So yeah, it seems encouraging to me.
Scotiabank brought in Scott Thompson,
From
who was
Finning.
from. So he had a banking history, and then he went to Finning, the heavy equipment company, and then he went back to Scotiabank. And of course, he'd served on Scotiabank's board since I think like 2016, and he was with Goldman Sachs earlier in his career. Like he had banking background, and yet everyone called him an outsider. And I remember the reaction when Scotia picked him. It was like, he's a trucker. Like, what are you doing? So, I see why TD maybe went a little bit more the traditional route because they saw what happened with Scotia. Even though Scotia has done fairly well since Scott Thompson took over.
Yeah. Okay, cool. So I'd like now to move on, I guess, to all the other banks. So you, as a Canadian person, you love Canadian banks, right? Like you have all of them, I think, or at least the 6 plus EQB, right?
Yeah. So my strategy is I don't know what's going to be the best Canadian bank in the short term. Over the long term, I think that they all have sort of interesting enough diversification efforts. So, of course, mostly they diversified into the U.S., but Scotiabank has done Latin America. And I think that for most of them, the diversification is interesting enough and they're well managed enough, and they all have similar moats in terms of they can access CMHC mortgage insurance, the riskiest loans. They're all part of the big oligopoly here, where it's tough to compete against them. They all have these advantages, and so if they all have these advantages, and I don't know which one's going to outperform in the short term, then my solution is to buy them all and perhaps slightly overweight my favorites. Now, so you're right. I do own all 6, and I own EQB, and that's it. There's a couple other. There's Laurentian. There's VersaBank. I don't buy those because they're not part of the oligopoly, right?
Right.
So that's the way I approach it, and then I have a slightly heavier weight to my favorites, and Royal Bank is my favorite.
Okay. Why is it your favorite, if I can ask? Is it because it's the largest?
So Royal has a number 1 or number 2 market share in every Canadian retail banking category, including wealth management, including bank offered insurance, and they traditionally consistently have a higher ROE and a better efficiency ratio than most of their peers. And it's just, there's a reputation in the banking world that the best bankers eventually end up at Royal Bank. So
I heard that
those
too.
three together, I think the quality is a little bit higher than the rest. But saying that, for the longest time, TD was kind of like a 1A to Royal Bank, like a 1A, 1B kind of situation. And TD has really fallen from grace. So that's why I own all six, to protect myself in case some specific company event happens.
That makes sense. One thing I'll say about RBC is they've been very, very consistent in that. I don't know if you remember, like a couple of years ago, right? It was number one market cap in Canada, and then
Yeah,
Shopify just took over, like it whizzed through, and then Shopify like basically kind of crashed, right? And RBC since then is still number one again, but now the gap is way more, like between RBC and TD. I think it's almost like 100 billion market cap difference now or something insane like that, where TD was really close not too long before. So yeah, RBC is super consistent. I like the CEO too. What's Dave McKay? I think
yeah, Dave
he's
McKay, yeah.
good. And you know what?
Mm-hmm.
I saw his post on LinkedIn the other day. He made a post about the Nike guy who did his entire career at Nike. And
Mm-hmm.
he did the same. Like McKay, he started as a co-op student in like the 70s or 80s. And he's had like I think 18 or 19 jobs at RBC. It's like having a whole career in one place. I find that so cool. But, you know?
You don't see that very often anymore. And you mentioned Royal Bank and the top market cap in Canada. I read something where it's consistently been the kiss of death for a company when you surpass Royal Bank in
Uh,
market cap. And so it was like Nortel in 2000 was
oh
one,
yeah.
and then Research in Motion in 2008, I think, where of course that turned into BlackBerry, which imploded, and then Valiant in 2013. I believe it was Valiant. There's another one, I believe it was Valiant, and then Shopify, like you mentioned, in 2021, 2022 there. And every time a stock has surpassed Royal Bank, it's been the peak, and then a year later, 2 years later, it's much lower than what it
Nosedive.
was. So if your favorite stock surpasses Royal Bank, history is not on your side.
Yeah. Okay. I'd like to move on to EQB now. As you know, it's my favorite bank. I'm a big fan. It's actually now
Mm-hmm.
my only bank. I have respect for all of them, but now it's my only one. What are your thoughts on it?
EQ Bank is a wonderful company that is doing really really interesting things in terms of their digital first approach. In terms of they basically built this. So every bank, of course, struggles with getting deposits, and deposits are what you need to like to lend, because you need to get that money in your bank and then lend it out. And what EQ Bank did is they basically built this deposit ecosystem from scratch. It was kind of this, they would fund using GICs. And of course, the easy way to get GIC money is you offer a little higher rate than the next guy. But they built this digital first bank that a lot of millennials are using, and they're parking cash in. And this part of the bank is just growing and growing and growing. And then they're using that as kind of low cost deposit capital to lend out to mortgage holders. And it all results in superior ROEs, return on equity versus its peers. And they're doing that, and they're growing faster than the other big six banks. Those two things together are a really powerful combination, and it's led to excess returns. I've held my EQ Bank shares since 2018, I believe.
Oh, nice. That was a good
I think,
returns.
yeah, I don't remember what my original cost was, because it's split
They
since
did a
then. I
split.
think it was
Yes.
I think it's split adjusted in the 20s.
Wow.
Um, so it's been wonderful for me. It started out as a small position, and now it's one of my larger positions, and I'm happy to hold. The dividend growth is great because they're growing like crazy. I'll say two things as kind of a bit of caution for everyone listening. One, I think the days of, they were growing 20, 25% a year. I think those days are over. I think it's more like 8 to 10% a year going forward, which is not that much better than like a national bank. National bank's kind of growing like, 7 to 9% each year. So it's still good and it's still quite attractive versus most of the banks. But that's a little bit of a cautionary thing I'll say. The other thing is that they're very exposed to Toronto real estate. I'm not a real estate bubble guy. I don't think Toronto's in a bubble. I don't think that, we're doomed and everything's going to go to zero like the naysayers say. But there is a little bit of extra risk having most of your assets tied to one local housing market that could experience some weakness if politically we turn off immigration.
Yeah. Agree with all those points. One thing about EQB, I don't know if you saw that, but there's all these like banking conferences happening like last month, and their CEO was kind of going around and telling people like, give us your feedback on our dividend policy. I don't know if you saw that. So
No, I didn't.
so I sent them a little message. I don't know if they would read it, but still, I was like, hey guys, my idea here is your dividend growth has been obviously amazing, right? So what they do that's different from the other banks is they have a very low payout ratio and they have much higher growth. So they're like a low yield, high growth type of model, right? And I said, you know what? I feel like anyone who likes EQB in general isn't in it for the like high dividend yield because you wouldn't have a high dividend yield, at least not immediately. So how about doing like Berkshire? I didn't say it like that, but I basically said, how about just not having a dividend and use the excess earnings to maximize your growth even more, right? Now, I kind of doubt that they are actually going to do that, but I feel like that would be awesome just because they're different anyway, and I don't think that they would lose the respect from their investor base if they did that, right? Because it's not like let's say a TD where people usually buy for the 4 or 5% yield. What do you think on that?
It would definitely be an intriguing experiment if they did that, because it's tough because I'm thinking of Main Street Equity, which is a real estate company. They own apartments mostly in Alberta, and it's a company that owns apartments, yet they pay a very, very, very small dividend. Like they just initiated the dividend, and their philosophy is like, look, we if you want a dividend from your real estate, buy a REIT. We're not a REIT. We're different, and that kind of differentiates them in the market. And what you do is you attract a different kind of investor that way because you're attracting the investor that doesn't care about the income. They want the growth. So I understand it from that philosophy. At the same time, it could be a very unpopular decision to be a bank in Canada and not pay a dividend.
It would be kind of weird.
EQ Bank suffers from trading at a little bit lower valuation than its peers, and perhaps in that situation that they would perhaps maybe trade at a lower valuation versus their peers, and they want to kind of do the opposite. They want to sort of bridge that gap, but who knows at the end of the day. And I don't know, it'd be a fun experiment, that's for sure.
It would be cool. I just really hope, and if the EQ Bank team is listening, I really hope that they do not do what the other banks do in terms of paying out like 50% of their earnings. I think that's not a good idea. I think they should, if they don't want to remove the dividend and keep it the way it is, just like that, 15-20% payout ratio and grow it fast, I think that's the sweet spot.
Yeah. Also, I was going to say they've been raising their dividend every quarter, and they've been doing that for a while now.
They have 22%
I think it's like
CAGR in the last 5 years. 22%.
Yeah, and so as a EQ Bank shareholder, and of course I said earlier that I insist on dividends, but I would be okay with them saying, hey, look, we plan to grow at say 10% a year for the foreseeable future. We're going to grow our dividend 5% a year because we want to have additional capital in to put to work in whatever, whether it's acquisitions or whatever they would decide to do. And I'd be okay with that. I would think that that's a prudent strategy for them. And the other thing is that they are so small compared to you'll know better than I will. I think there's something like 600,000 bank accounts. I don't know, like I'm less than that.
Yeah.
And I think like CIBC has something like 8 million customers or
Oh,
something.
yeah. They're
So
still very
it's
small.
just, yeah,
Yes.
like they're very, very small compared to the big six. And that digital platform is very interesting. But at the same time, Scotiabank has Tangerine, CIBC has Simply, and I'm a Simply customer, and it's maybe not quite as good as EQB, and but the banks have these digital kind of platforms themselves, so that
Yes.
presents maybe a little bit of a challenge, but not enough for me to get excited and sell or anything like that.
Yes, I will say from my own perspective, and again, as a big fan of EQB, and I have an EQ Bank account, but I also have a Tangerine account. I've had Tangerine longer, like I had it before I even knew of EQB, and it's
Mm.
definitely a formidable opponent. Like Tangerine is, it's not bad. It's a very decent digital bank. So yeah, there's definitely competition out there. Okay, I want to ask you very quickly about U.S. banks. You only invest for banks in Canada, right? Or do you own any?
Correct. I
Yeah.
don't own any U.S. banks. There's two reasons. One is because I have enough exposure through my Canadian banks already, and
Fair.
two is I don't think U.S. banking is nearly as good of a business as Canadian banking. You don't have that oligarchy situation. You don't have a government-backed mortgage insurance provider. There are a few institutions in the U.S. you would call kind of too big to fail, but for the most part, it's very fragmented, and you just put all that together, and it's not
Not worth it.
that exciting of a business for me. I'd much rather just own the Canadian ones and have my exposure that way.
Yeah, to me, the U.S. it always feels a little bit like the Wild West sometimes. Like, do you remember a couple of years ago there had these banks that were just falling apart? Remember, like 2 years, it was like two or three of
Mm-hmm.
them all in one
Yep.
go, right? And it's like what? And it surprised everyone. Everyone was like, "Oh my God, I can't believe this happened." But this happens every few years where a bunch of those American banks just kind of have these problems, whereas we haven't really had a situation like that in Canada with the big ones really, right? They're still there, even with the TD stuff going on. No one for 1 second thinks that TD is not going to exist anymore tomorrow, right? It's still going to be here in like
Exactly.
100 years. So that's a big deal for sure.
Yeah, I think Canadian banks are more conservatively managed than U.S. banks, and when you are trying to gain market share in a crowded market, sometimes you do silly things that jeopardize the long-term health of the bank, and that is, that's not what you want as a bank investor. If I were to invest in U.S. banks, it would be J.P. Morgan, Bank
Hmm.
of America, the kind of top three or top four, and that's as far as I would look. I would not be too interested. And there's, I'm a value investor at heart, and there's lots of bargains. If you look at small banks, you can buy them for under book value, and you can buy them for single digit price to earnings multiples. But
Wow.
I'm just not interested. I'd rather buy Royal Bank and sleep well at night versus buying, some rural New Mexico bank with 26 branches,
Yeah, makes sense.
even if it is
Okay.
cheap.
Yeah, yeah, yeah. Let's move on now to probably my favorite topic of today is the food industry, fast food. So you are the expert in the FinTwit space on A&W. I will tell you, I don't own A&W, but I am a fan. I've made you a lot of dividends probably. I really like their, I think
Excellent.
it's the Nashville Cruncher. Have you had that?
Oh yeah,
That's a good one. Yeah, yeah, yeah.
that's a good one. Yeah, yeah,
I like that one very much. So, and also like their they have these like mini wraps, like snack wraps.
yeah,
Like the Chipotle mayo wrap, whatever. I forgot what it's called,
yeah,
but that
yeah,
that
yeah.
one's very good. Yeah, my wife loves that one too. Okay, so tell us everything about A&W. We know that there's a lot of stuff going on. They had this deal. They changed their structure or something. They merged the one of the units with the other. So just explain what's going on and is it a good thing or not?
Sure. So the way A&W exists as of this moment, not for very much longer, but as of this moment and before, it was a royalty fund, royalty trust. So what it was that owners of the royalty, so shareholders of the royalty, got a 3% top line royalty stream from A&W sales. So the advantage to that was that no matter what happened, you got paid off the top end sales, and then the A&W food service, whatever, kind of got the rest. But what happened in that model is it limited growth, and it limited growth in two ways. And one is that if you're a good operator, you'll keep as sales go up and your expenses they stay the same, your profit ends up being higher as a percentage level. So as the royalty holders, we were limited. All the upside we got was from sales growth, and that was it. The second thing was that the structure was that when A&W Food Services, so it was the operating company, when they would open up new restaurants, they would get units of the royalty company in exchange for adding to the royalty pool. So it sounds a little bit complicated, but what ended up happening is that A&W Food Services ended up owning about 30% of A&W, the royalty company. And what that did is that also limited upside, because when a new restaurant would come in, it would be a kind of a neutral transaction for A&W royalty holders, because they'd get the benefit of the new restaurant, they'd have to issue shares to kind of get that. So it was a neutral transaction. So what happened is that the two companies basically said, we're combining. So A&W Food Services is buying out A&W royalties, and then A&W Food Services will list on the TSX. And what that does, there's a few different advantages. One is that shareholders get the full benefit of the combination of the two. Two is that A&W Food Services gets paid a royalty for every bottle of A&W root beer that Coca-Cola distributes for them. And three is that the growth potential of the whole thing is going to be much higher. So you put kind of all that together, and the other advantage is that it's a much kind of more conventional company now. It's structured the same as a McDonald's, as a Restaurant Brands International, and so on. So it's less complicated. People can understand it better. And you combine that with the potential upside. I'm a big fan of this transaction.
And maybe that'll attract a higher multiple too, right? If it's like RBI and all the others. I'm just realizing that as you're saying. Yeah, okay. So you would think for the average investor, like in general, considering the food industry, this is probably more attractive now because it's like apples to apples when they compare with the competitors.
Exactly. And the dividend is staying the same. So you
Nice.
still get a very attractive dividend. I think it's about 5.5% right now, with a strong history of dividend growth. They haven't quite grown it every year, but they have consistently grown it over time. They cut it during COVID, but a lot of companies cut it during COVID.
Yeah.
So you kind of have a strong dividend today, and what looks likely as having pretty good dividend growth potential going forward as well. So you get that nice combination of a high yield today and that growth potential going forward. Although if I were A&W, I would probably do exactly what I was saying as with EQ Bank there, where it's like, grow earnings maybe 7% a year and increase the dividend by say 4% a year to give yourself a little bit more capital to help expand and things like that. But it's a very asset light business model, right? What do you do? Like the franchisee is the one that pays
Does
to
all
have
the
the
work.
thing does all the work and puts up all the capital, and you just kind of collect the royalty. So it's a very capital light model. And I think like they spent like $2 million in capex last year. Like it's not much.
Seriously?
It's just
That's like
only
nothing. What?
it's nothing.
In all of Canada, or in just
that
like one town?
no,
What?
like the parent company is just go ahead,
Oh
do
wow, that's so cool.
you pay for it, and so it's very, very asset light. In fact, the only big investment they've made in the last kind of 5 years is building out the app. Other than
Oh
that,
yeah, yeah, yeah.
they have no plans to make any big investments over the
Yeah.
next few years. So there's a lot of cash flow that's going to be coming to investors, and as I said right at the top, that's what I like, is lots of consistent cash flow.
That's pretty good. And you know what? I had a conversation with Willows about this. I don't. Yeah, you know what? Yeah, I had this. I don't know if you saw. I did an episode with him about on his show about Brookfield, And that episode is like an hour and a half long, but we actually talked for like 2.5 hours. And the other
Yeah.
hour was about a bunch of other random stuff, which I don't know if you'll upload it or when he will. But we talked about A&W briefly, right? And I know, and I think he and you agree on this, right? That you like the strategy that, stay in Canada but do it well, right? And the thing is, I like the global stuff, but I will say I can appreciate staying somewhere and doing it very well, especially because the capital needs are much lower. But if you do well, you're like gushing free cash flow all over the place, right? Because sometimes
Mhm.
pursuing, acquisitions or international expansion, it costs a lot of money and you don't even know if you're going to do it properly. And if you don't, it's a big waste of everyone's money and a waste of time, really, right? But if you're already doing well in Canada and you just continue what you're doing, that's like a surefire way of like doing okay. You know what I mean? Like, so
Mhm.
yeah.
Yeah, the other thing about A&W is they have signed a deal with Pret de
Oh yes,
Manger.
yeah, prêt à manger. Yes.
And thank you for saying that properly
Yeah,
because I
yeah,
always butcher it. But they've signed a deal. They have exclusive rights to expand it in Canada. I was recently in Toronto and I went to the location on I think it was King Street, I
yeah.
believe that
King
that
of Front
is
Street. Yes.
the that has the Pret product in there because I went to England and I fell in love with the mac and cheese and so I went and I got it at the A&W and they kind of had the little Pret in there. So there's potential for kind of the grow the business that way and to incorporate Pret into some of their existing stores. But I think eventually the plan is to attract Pret franchisees and
Mm.
kind of have a dual sort of model happening there, which would be further upside for A&W shareholders because we get, we own that, we get exposure to that, and hopefully it works and they can kind of use their expertise in the Canadian market to roll out Pret,
Hmm.
and even in just a small way would help the bottom line ultimately.
Yeah, 100%. Another thing that I like about A&W too is I feel like their brand positioning, they did a very good job of seeing like a good corporate citizen. You know what I mean? Like a lot of
Mm-hmm.
people, McDonald's and all the stuff with like Israel, Palestine, people don't like, you know what I mean? People are really upset and stuff. And A&W is kind of like this, Canadian brands that doesn't do anything that no one is upset about. You know what I mean? They're just kind of sticking to their stuff and that's it's like intangible, but it's part of your brand power, right? What do you think?
They've also had a kind of a better for you kind of approach to it where there's um antibiotic free
Yeah, no
eggs,
chemicals all over the
no
place.
chemicals, the hamburgers are no hormones, which of course I'm from rural Alberta and I talked to a farmer about that and he was given the opportunity to raise cows for A&W and he turned it down
Ah,
because apparently they're a little bit when you don't inject the cattle with hormones, it's harder to keep them healthy versus if you do. So that was interesting. But the point is that they market to millennials. They know their market, and that's what millennials are looking for is a little bit kind of higher quality product, a little bit better for you, and they're willing to pay a little bit more. And A&W understands that market, and they've done a wonderful job um, embracing that market.
mm-hmm. Yeah, yeah, yeah. Cool, man. Okay. I am a big fan of A&W. Even if I don't own it anymore, I did sell during COVID. When they cut the dividend, I was like, I can't forgive that.
Mm-hmm.
But I saw that they started paying again, and they even tried to pay back the dividends that they cut, like something like that. It was really cool. But anyway, even though I am a fan, I own their big opponent, RBI. I want to hear your thoughts on it. Maybe now versus a year or two ago, because they've been changing a little bit. What do you think?
So for the longest time, um, I would go into Tim Hortons, and I'm not a big Tim Hortons guy, but my wife loves the coffee, and so we go in there all the time. And for me, it was always a struggle because I always felt like they were always busy, but it was just I thought they were poorly managed. I thought Tim Hortons was a poorly managed organization, and I would see some of the products that they were bringing out, and I would just kind of shake my head. The I remember the biggest thing I made fun of was the Tim Hortons poutine. I thought that was
Oh
just so
God.
off brand.
Yeah.
Um, but saying all that, I will give them credit. The sales, same store sales growth is strong. Um, they've really done a nice job in the beverage space in terms of expanding from coffee, and expanding from these kind of traditional favorites you've seen at Tim Hortons forever. The food, the pizza, and I like pizza, but I don't really like Tim Hortons pizza.
That's fair enough.
But it's popular. People are buying it, and it all translates into same store sales growth, and it's been a lot better than what I anticipated it would be. So kudos to them. They're doing a good job there. Um, as for the other parts of RBI, Burger King is improving. They've done a nice job, sort of, kind of turning that around, and they're sort of continuing to turn that around. And then you've got Popeyes, which I think is excellent. I think it's well ran.
Yeah.
I think it's delicious. They're growing. I'm in Edmonton, and it seems like every 6 months it's like, oh, there's a Popeyes there. I didn't realize that.
Mm-hmm.
They're growing. And Firehouse subs, same thing. They've, in my neighborhood in Edmonton alone, there's one that just opened, and there's another one that will open in the next couple months. So there's growth from those two brands. So you put it all together, and I'm definitely, I'm not going to say bullish yet, but it's on my list of companies to look into more, which a year ago it sure wasn't. A year ago I was pretty adamant in
You're
my
like, no, yeah,
adamant in my Tim Hortons hate, but
yeah. That's
they've
fair.
done good.
Yeah, I mean, yeah. Tim's, I have a love-hate for almost a love relationship, but sometimes hate when they got, because I don't talk about it some parts, but I hate cheese. Like I just can't stand it. And I've had times when I ask for a sandwich with no cheese and they give me cheese. But anyway, one thing to go back to that point I made about A&W being great because it sticks to Canada. One
Mhm.
thing that Burger King in particular did that where it's the opposite that I like is that they've kind of changed their operating segments. So now they have basically Tim's, Burger King, Popeyes, Firehouse, and it's basically Canada and US together. And then they have an international segment, right? But before that, when you could see the Burger King international results, they are so good. Like Burger King outside of North America is
Mhm.
like the greatest burger company in the world. Like South Korea, France, Germany, Australia. In Australia, it's called Hungry Jack or something like that, which is
Yeah,
really
yeah, that's
funny.
right.
Yeah,
Yep.
the digital sales over there, it's like in South Korea, it's like 95%. It's insane. And so now in the US, they are using all those best practices that the teams internationally are, gathering. They're using that for their remodeled restaurants called the sizzle format. I don't know if you've seen
Mhm.
them. They look so cool. And so it's already started, right? They've already opened a few of them. And the data shows the minute that it's open and it's there and it's so modern, the sales go through the roof. So by I think it's 2027 or 2028, they'll have remodeled like 90% of them in the US. That is going to be a game changer. I'm just saying this in case thinking of catalysts for the future. That's going
Mhm.
to be pretty good because you're seeing it already now starting. That's
Uh,
very
I'm a
exciting.
I'm a big traveler. I spent much of 2023 traveling around. It's my first year of early retirement, and I really took advantage of it. And you're exactly right in terms of the A&Ws. I went to one in Germany. I went to at least one in England, and I think there's one somewhere else I went to too. The international A&W, the international
Burger King. Yeah.
Burger Kings are good, well ran locations, and they were busy when I was there. They were
Hmm.
doing just as well as kind of similar McDonald's locations. So you're right. The international operations for Burger King, what I saw anyway in my travels, they're doing pretty well.
Yeah, they are. Even Firehouse subs. You know what? When they announced the acquisition, I was like, "What is that?" I'd never heard of it before, right? And then
Mm-hmm.
I try. I don't know if you've had it, but it's really good. Have
Mm-hmm.
you tried?
Yeah,
Yeah.
I had one in, I think it was the Minneapolis airport, that I and that was it. I Firehouse subs. Like, I'd try this. I knew that they had just acquired it, and
Yeah.
so I went and I tried it, and it was better than Subway, that's for
Yeah.
sure.
Much better.
Yeah, much better than Subway, and it was just kind of a little bit more of a grown up kind of Subways versus the same thing you see everywhere, where it's like,
Yeah.
okay, what do you want in your bread? What do you want in vegetables? So
Yes.
I think that it's an interesting kind of concept, but I think the most interesting thing about that is that they're showing investors where it's like, look, we acquired Firehouse Subs, we've integrated it. We can turn into this franchise roll up um, company, and the sky's the limit. You once you show you can operate 4 different chains, why not 5 chains, why not 6 chains, and then you become this franchise powerhouse, and that's a
Mhm.
very interesting investment thesis.
Yeah, that's what's so exciting to me. And just fun random anecdote, but I know personally a couple of people who went on to work at RBI, like in the Toronto HQ, which is right downtown. And
Mm-hmm.
they're some of the smartest and hardest working people I know, and humble too. And I listened to an interview. It was their chairman, Patrick Doyle or Doyle, I think.
Yeah,
Him
Doyle, I think.
and the CEO. And it's that podcast called In Good Company. If you haven't heard it, it's a really good podcast. Anyway, they were talking about the profile, the type of employees that they try to hire, and literally it was exactly that. They're like, we don't care about how smart you are or how hardworking you are. If you're not also kind of humble at the same time, you have to be able to really, roll with the punches, and just be a good person and work as a team. So they're not like ego driven and just like these random maniacs that you see in a lot of, big corporations, right? It seems like they really try to have a system for the type of personality that they hire. And I just thought that was interesting, even if again it's an anecdote. But it's literally two
Mm-hmm.
people that I know, and I'm like, oh my god, that it's great that they're there. So yeah, I'm very bullish on that company.
Yes, I know you are.
Yeah. Okay, I want to hear your thoughts on the other competition, like McDonald's and all of those. What do you think? Do you own them? I don't know.
So I do own McDonald's. So I'll tell you a story about McDonald's because it is one of the very first stocks that I looked at when I was a young investor. It was 2003, I believe, and Super Size Me, the movie,
Oh, yeah.
um, came out, and there were a bunch of things that were impacting McDonald's at the time. And I remember the stock went from, I think it was a high of about 22, and it was down to 13. And I remember saying to myself that I'm going to buy in at 12.50. And 12.50
Oh.
was the number that I picked. No, well, it doesn't matter because I don't know if it was 12 or 12.50, but it never got to either of those numbers, is the point. And it was because Kevin O'Leary was on BNN back then when it was called ROB TV. And Kevin O'Leary said he was buying in at $12. So I was going to buy in at $12. And it went to 12.75 or something, and then just shot straight up. And within
Oh
a year, it
man.
had doubled,
Yeah.
and so on and so on. And I missed out on that one. And it was a valuable lesson, but at the same time, I was 19 years old back then, and I would have bought at 12 and I would have sold at 24 because I didn't understand the good things about compounding as well as I do now. But I recently corrected that mistake, and I bought right around 250 a
Oh,
few
that was the
months ago.
perfect price. Yeah, yeah, when it dropped.
And
You got it
it
right
was
at the bottom.
down,
Yeah.
and it was down, and I bought some, and now I get to tell everyone that I own McDonald's. And the thought process when I bought it, I wrote about it on my newsletter. It was, the lazy analysis is, oh, McDonald's, the food is bad. It's a Big Mac. They've had the same thing for 30 years. McDonald's is a real estate company. When you go, and I've traveled, when you go around the world where people gather, there's McDonald's. And they've had a 50-year head start on all of its competition to get the best locations around the world. And they have it, and they have this wonderful real estate network. That's the moat. It's real estate, and then it's you. When you have kids, you take your kids to McDonald's. That's where they want to go.
Yeah.
So you put those two things together, and I was happy to buy it, and it's something that I will hold, I think, forever. I don't have any plans to sell.
Mm. Yeah, man, it's a compounding machine. And you know what? I will say, I used to be kind of how you were about Tim Hortons. I was like that with McDonald's, where for years I was like, man, that food isn't that good. But I
Mm-hmm.
actually think they've made a lot of progress. Like now I actually go to McDonald's. Have you had the McGriddle before?
Oh yeah,
That's actually it's nice.
it's
Like I
delicious.
can eat
Yeah,
it and I'm like, "Oh man, this tastes good." So I like that, and they really got me too in the summer with their $1 coffee thing if you use the
mm-hmm.
app.
Yeah.
$1 for a large coffee. So for like 2 months I didn't go to Tim Hortons because I had $1 large iced coffee. Like, come on, hello. Do you know what I mean? It's crazy. So I really like also that they started as this burger company and they managed to become also a drinks like coffee,
Yeah.
breakfast business. Like that's hard to do, right?
I
Like Burger
remember,
King doesn't have coffee.
yeah,
So
I was gonna
yeah.
say, I remember when McDonald's had that terrible coffee in the styrofoam cup that was the temperature of the surface of the sun.
Oh God.
And like, I'm not a coffee drinker, so I don't know, but everyone who was a coffee drinker, it's like, oh, this coffee is absolute trash. And probably in the early 2010s, I'm going to say, they really, especially in Canada, like they went after Tim Hortons and the coffee business, in the donut business, in the beverages. They've got the
Hmm.
smoothies there now.
Yeah.
They've really done a nice job on the beverage part of it, and they've kind of taken these lessons from Canada and they've imported them to other markets, and
Yeah.
they are a legitimate competitor in coffee, I think, around the world.
Yeah,
And it's just
legit is the
something,
word. Yes,
yeah.
exactly. They're legit. Like now,
And
it's not embarrassing to say I'm going to McDonald's for coffee, right?
mm,
That's a big deal.
that is a big deal. And it's just, that's a market that they sort of organically went into and stole from Tim Hortons or Starbucks or whatever. They've done a really nice job there.
Hmm. What do you think of Yum Brands? Do you know Yum Brands?
Yum Brands, I haven't done super deep work on it. The only thing that I will say that I'm comfortable saying is that I think Taco Bell is a really special brand. I think their marketing is A plus. The food is, it's like, I eat it and I say, boy, this is trash, but it's delicious. I don't know what it is. And I read something recently where franchisees are very happy with Taco Bell and they like it because you can make all of the meat at the beginning of the day and you just like reheat it
Oh.
as the day goes along, and it's much easier to
Uh-huh.
staff and to deal with versus a McDonald's or whatever, where you've got someone cooking burgers all day long, someone cooking
Hmm.
chicken all day long, and this elaborate warming system and so on. So it's easier to manage the kitchen of a Taco Bell, and that's a big
Hmm.
plus for the franchisees. And in general, my philosophy is if the franchisees are happy, then I'm interested as an investor.
That's a very good philosophy. It's interesting what you mentioned about the kitchen. I know it was maybe 2 or 3 quarters ago, maybe 3 quarters ago. Popeyes, I know that they launched an internal program on like remodeling, remodernizing the kitchen equipment and some of the processes by which they make some of the foods, all to actually just simplify the process for the franchisees and the employees dealing with, how to make these chicken wings with that flavor and all that kind of stuff. And that they were very bullish on that process. They said it was going to take a little while, right? Like a year or two,
Mm-hmm.
but they said it's going to be a massive game changer internally, even if customers won't realize. But yeah.
If I mentioned that I worked at the head office of a grocery chain, and so I was in the unique position in going from working at the store to working in the head office, and so I had experience in both. And my experience at the store level was that anything that head office can do to make the day-to-day operations go smoother is very much appreciated, because usually head office, when they insert themselves into a situation, it just annoys the frontline workers. It's
Yeah.
extra work for them.
Yeah.
And so if head office can come and say, look, we're making this easier and we know we're making this easier because of XYZ, that's a positive um,
Hmm.
transaction every time.
That's a huge plus. Okay, let's move on to perhaps the most important topic of this entire evening. This is where I really need your brain because I'm very curious what you think. And that is Alimentation Couche-Tard. Everyone knows the company, right? It's this giant convenience store chain. It's maybe going to become number one in the world. I need to know everything you know about this 7-Eleven deal. What is it a good idea? Is it a bad idea? Can they do it? Like, are they capable of it? What do you think?
Here's what it boils down to from my perspective, is that 7-Eleven does not want to be bought, and they definitely don't want to be bought by a bunch of Canadians. And
Yeah, that
I
is
say
true.
this in, like the most loving way possible, because I was in Japan about little less than a year ago, about 11 months ago. And one of the things I made sure to do while I was there is go into many, many 7-Elevens, because they are the coolest thing. It's like they're like 10 years in the future compared to what
Mm,
we are. And, they have ready prepared food just like our 7-Elevens do, but the variety is stunning. They've got, dozens of different kind of hot dishes you can buy. There's a big wall of ramen that you can buy. You can go in there. Some of them have counters where you can sit, and there's hot water. You can make your soup, you eat it there, and it's just this perfect kind of on the go place to sit and eat your meal quickly and then go. And it's a big part of the culture there, because it's
mhm.
it's very work oriented culture. So it's very, very interesting to go to those 7-Elevens, but it's they're they're fiercely Japanese, and they're fiercely protective
Yeah, they're
of
proud.
these 7-Eleven. 7-Eleven is theirs, and they don't want Canadians owning it. And I think that that's sort of the message that 7-Eleven is trying to give to Couche-Tard. And Couche-Tard, they want it because they see the potential in it. And so you've got sort of this fight going on. But at the end of the day, I think that Couche-Tard wants it, but they won't get it. And I'm a little bit skeptical on sort of transformational acquisitions to begin with.
Mm,
It's hard. It's hard to buy, like, how many 7-Eleven locations? I can't remember how many
there's
they are,
way
but it would,
more
like, yeah,
than Couche-Tard. It's like
it
triple or something. It's a large amount.
it's a
Yeah.
very, very large acquisition. And yes, Couche-Tard has experience buying things, turning them around, making them run more efficiently, but that is a big nut
Yeah.
to chew. And I would be a little bit worried if I was a Couche-Tard shareholder. And I think that's why the stock has sold off. What is it, 15% since
Something like that.
the deals was announced? I think it's a big part of the reason why.
Yeah. Okay. So, well, what I was hoping that you would have a more bullish opinion because I needed to hear some bulls. But I know I feel quite similar in that to me it's like if anyone could do it, it would be them. But I just don't even know if they can do it because of that's assuming that the acquisition goes through, which it probably won't. But if it does, I am a little scared because of how big, like it's so big, and it's like you said, it's very hard, and I am scarred by the worst investment I've ever done, which was a great lesson, was Teladoc. I don't know if you've heard of them, Teladoc Health, but they acquired a company called Livongo. It was the same thing, like a giant company, and it was just a disaster. And it's down like 90%. It was very poorly done. And then as the stock was falling, they had to start writing down like a impairment charge on the
Mm-hmm.
acquisition,
Yeah.
right? And if I mean the loss per shares were astronomical. I've never seen that ever. So that I'm not saying that that's going to happen to Alimentation Couche-Tard, but that's what I'm always thinking of when I see an acquisition this size.
Exactly. The if they do succeed and they get 7-Eleven, there's all sorts of uncertainty in terms of how much stock will they have to issue to pay for
Yeah.
it, how much debt will there be, and one thing the market hates is uncertainty. So there you have that issue there as well. I do think that the way the situation is kind of shaping up now is that they've they've made an updated offer to 7-Eleven. Like I said, I don't think it goes through, but what they can do once the deal's officially over with and kind of rejected is they've got something like $2 billion of cash on the balance sheet right now,
Buyback stock.
which of course is there for to help pay for the acquisition. And if that doesn't happen, all of a sudden they can turn the share buyback back on.
Yeah.
And they've been an aggressive repurchaser of their own stock in the last, call it 5 years, 6 years, and they can make a nice dent in shares outstanding at a potentially pretty attractive long-term price. So, for a long-term investor, I don't think the kind of buying Couche-Tard is such a bad idea at this point. I generally like to look for solid companies that are trading at 52-week lows. Couche-Tard checks that box. But in that sector, I'm more bullish on Parkland than I am Couche-Tard.
Interesting. Okay, I wanted to ask you about Parkland, so let's talk about it. I don't know very much about Parkland. I do know that Couche-Tard has done much better than them over, let's say, last 10 years. So tell us a bit about like what did they do and why was Couche-Tard better over the last 10 years and why maybe is Parkland going to be better in the future?
Well, so you're right that Couche-Tard has performed better than Parkland over the last 10 years, 20 years, but Parkland has performed quite well themselves. I believe they're up 12% a year, 11, 12% a
It's
year
still a good
for the
company.
next 10 years. And
Yeah.
I think the results have been even better for the last 20 years. So Parkland started out as a single gas station in Alberta, and then the company expanded and expanded. Then they acquired a small refinery in Alberta, and they also acquired oil production assets. They wanted to be vertically integrated, and it just grew and grew and grew from there. And eventually, they became this sort of weird combination of they're mostly gas stations, service stations, but they're spread throughout Canada, United States, and into the Caribbean. They made a big acquisition in the Caribbean a few years ago. And so like Barbados and a bunch of other Caribbean companies, like they're the dominant gas station convenience store chain in these markets.
Oh, wow.
But Parkland also owns a big refinery in Burnaby. So the biggest one in BC anyway, and it's one of the biggest ones in Canada. I think it's about 250,000 barrels of oil a day it can process. Wow. It's a big refinery. And they've got kind of these gas, propane distribution companies sort of that kind of service their gas stations, but service kind of other gas stations as well. So what's happened is that there's this mishmash of assets a little bit, and the market likes pure plays. So activist investors have got involved, and the activists have said, listen, you need to sell the refinery, you need to sell these other businesses, you need to do this, and you need to become a pure play convenience store operator because that way you'll attract a higher multiple.
Yeah.
Then the other thing that's happening at the same time is when Parkland acquired the Caribbean assets, they paid stock, and Simpson Oil was who they acquired it from. And the Simpson family is the richest family in Barbados, and I believe the richest family in the Caribbean. And so they got these shares, and now they signed an agreement that said that they would be a passive shareholder. But now they're a little bit upset because they want more dividends and they want more income. Basically, they want to maximize the dividend that they're getting from these shares. So allegedly, Simpson worked with a buyer, Sunoco, and wanted Parkland to sell out to Sunoco. And Parkland said no for a number of reasons. And then Simpson said, you need to sell the company because it's too cheap. And then Simpson is working behind the scenes, again, allegedly, to try to broker a sale. And there's a lawsuit because Simpson wants to be an activist shareholder rather than a passive shareholder. Simpson is upset at the way that Parkland is being run. And finally, Parkland has told investors that they won't make any acquisitions for the next 12 to 24 months minimum because they, one, want to pay off debt, and two, they want to improve their existing stores. They want to do things like expand the food offerings, build out their loyalty program, and so on and so on. So combined, the market doesn't like this because there's a bunch of sort of strikes against Parkland, a lot of drama, etc. But it trades at about 7 to 8 times forward free cash flow and about 10 times forward earnings. So it's cheaper than Couche-Tard. And my thought is that Parkland capitulates to all this pressure. They sell the non-core assets. They become a pure play convenience store operator. And then a known acquirer of convenience stores gets interested at that point.
And the
So I
stock
think
goes,
that's the thought process.
yeah. Oh, yeah. You said 7 times free cash flow. That is
They are
incredibly cheap.
they are very cheap because there are a number of reasons why. Like I mentioned, the refining business margins in the refining business called the crack spread, and the crack spread is not great right now. They so the earnings from the refinery aren't projected to be as high as what they were before. And refinery earnings are kind of lumpy in terms of sometimes the crack spreads are good, sometimes they're not. And the market doesn't like that. Like the market just wants the good, consistent earnings
Consistent.
from the convenience store
Yeah.
operations. So there are some negatives for sure, but there's some really good assets there. The price is right. And there's a lot of people, a lot of rumblings behind the scenes to try to encourage Parkland to create shareholder value.
Mm-hmm. Well, hey, if they keep up the pressure, it's quite likely, I would think, that at some point the board says, okay, we'll do whatever you ask for.
That's it. And
Yep.
just they pay a 4% dividend while you wait. So
Wow, okay, yeah. And it grows,
I
right?
yeah, it's grown by about 3% a year for the
Okay.
last few years, and the dividend growth is a little bit slow because they're using a lot of their excess cash flow to pay back the debt. Their big concern in the short term is get the debt a little bit more under control so they can start acquiring again. But I don't think that happens. I think some external event happens before that.
Okay. Quick question on, I guess, both for Parkland and for Alimentation Couche-Tard on this is the rise of electric vehicles. Now, I am not one of those people who says that tomorrow the world is going to be only electric and EVs everywhere. I don't believe that. But I do think that the proportion of EVs is going to keep growing. It's quite
Mm-hmm.
likely. How do you see the future of convenience stores and gas stations? I know that they are installing electric plugging devices everywhere, but I look at the Couche-Tard revenues. I think fuel is like 75% of their revenues or something. So is it going to be 75% electric? I don't think so. So what do you think is going to happen?
It's tricky. I don't want to foster a guess at this point. It's very, very early in that transformation, but you're right. Like it's very obvious the growth is coming in electric cars. And that's going to get more and more big over time, and that will be an issue for those guys. You know, for me, I like when it comes to Couche-Tard or Parkland is it's the convenience store operations that I'm really interested in
Yeah.
anyway.
Hmm.
Fuel is when I buy fuel, I look for the cheapest fuel I can get, and I don't really care about loyalty programs or anything like that. And I know from my experience in grocery that the inside the store is where the money is made. And when you do charge an electric car, if it takes 20 minutes, what are you going to do in the 20 minutes that it takes to
Hmm.
charge? You're going to go in, you're going to get a coffee, you're going to do, etc. So I'm reserving judgment until I know more about what it'll do. But is it something that keeps me up at night currently? No. Will it be a problem at some point? It'll be interesting to see how they handle it.
Hmm. Okay. Yeah, I feel about the same too. Maybe it keeps me up at night a little bit more than you, but maybe I have a bigger proportion of stocks in in that industry. I don't know. I think about it and I'm like, man, I don't know. But yeah, well, I guess we'll see. Okay, moving on. I really also need your brain for Nutrien. This is a business that I owned like 5 years ago, and it went up a little bit, quite a bit, and then I sold because I got scared, and then I guess it was the right thing because then it fell. But now I'm thinking about it. This is like one of the largest potash producers in the world. Canada is one of the largest potash countries in the world. But I am wondering about BHP is building a mine right next to them, so in Saskatchewan, and it's
Mm-hmm.
gonna add, I think, like 15 or 20% to the global output of potash. Maybe not that much, but it's a very large number.
Yeah.
What do you think on about all that?
So the BHP mine is an issue. There's no doubt about that. Now West Shore Terminals, which is the coal exporting terminal in Vancouver. I follow that one as well. And West Shore has already come out and said, we have an agreement with BHP. BHP wants to export most of that potash to various customers around the world. So BHP is saying we mostly just want to export a lot of this potash. So that's a plus. But if the export market kind of isn't what they expect, then that could be an issue. Now, what I like about Nutrien is vertically integrated in terms of they own the potash production, and they also own the largest agri retail business in North America. And if you're a farmer in rural Alberta, you pretty much have to go to Nutrien and buy their products, and you buy their potash. So I like that about Nutrien. I like that it's vertically integrated, and I like that the retail operations give steady profits no matter what happens to the price of potash. But ultimately, Nutrien still will trade based on potash and based on the expectations of potash. And what you're saying about the BHP mine is people are worried about too much supply in the North American market.
That's exactly
and that's why Nutrien shares are down and they're a little bit depressed right now. And, you know, when they rode up, they're big in 2021. That was all potash price driven. So ultimately, it's one that I like. I think it's cheap, but it's not something that I would kind of buy and hold forever. I think it's something that you have to trade a little bit more. It's just not. It's I don't see a future where the potash influence is smaller than like I don't see a future where everyone cares about the retail business and they don't care about the potash business.
Yeah,
They're always going to care about the potash business more than they care about the retail business, which is too bad because I think the retail business is a nice little asset. It's got that sort of not quite a monopoly, but it's pretty close. It dominates the market. And nobody cares because it's just what's potash doing this week, next week, next year. So
with that said, and I'm glad you brought up the retail business. It seems to me like one of those most resilient oil companies, the ones that when, you know, the price isn't what we like, they are still resilient and they'll still sell and make profits and they'll be all right. And then when the price of the commodity is up, they make super profits and they like maximize buybacks and they increase dividends to so much, you know what I mean? So I feel like Nutrien, maybe some other potash companies, when BHP comes in and floods the entire market, some others may actually be in deep trouble, and Nutrien is gonna kind of suck, but it'll be okay. They're still gonna survive, right?
Yeah, that's a nice way to look at it. I agree with that perspective for sure. Where it's like these guys are good operators. They've been through a number of booms and busts before, and they've managed to survive just fine. And I think it was 2016, 2017 that potash combined with Agrium to create Nutrien. And ever since then, Nutrien has been an aggressive repurchaser of its own stock. They've made, I don't remember the percentage that they've kind of eliminated offhand, but just consistently buying back stock. And they've done a nice job, and they continue to buy back stock today when the shares are cheap. And I definitely get excited about that when I see a company doing that.
Love a good buyback. What do you think of their leadership? They had some weird stuff going on with like 2 or 3 CEOs in like the space of a year or something. Like there was some corporate drama or something. Do you know about that?
I didn't follow it close enough to have an opinion, but that's also an issue for sure.
Yeah.
Whenever you get a little bit of that, it's like, what's going on here? Like,
yes, I was
what's
wondering.
the problem?
I think that the one now has been there like the longest of all the ones that have been kind of like coming and going for the last 4 years. But yeah, I was just wondering because I really liked the guy. I think he was the CEO of Agrium before. His name was Chuck Magro. That's when I bought into Nutrien because I really liked him. And then he was the first of the series of guys that just left out of nowhere. No one knows why. To this day, no one knows why he stepped down. He just like left. So
just
anyway,
vanished. Yeah,
that was strange. Okay, moving on quickly to Dollarama. This is like the best, one of the best Canadian companies ever. For anyone looking, you can check, and I think I'm telling the truth, but if you look on the charts, It's like one of the greatest total returns in the last 20 years or something of Canadian companies, if you include a dividend too. Uh, but it's always so expensive. What do you think? When is it a buy?
I bought Dollarama in 2018 for there was about 3 weeks that had traded at below 20 times forward earnings,
Wow.
and I bought a small position. And every week I look at it and I say, man, this thing's at like 30 times earnings, 32 times earnings. It's like, this is really expensive. But I haven't sold. I've held on. The way I view Dollarama is so when I worked in grocery business, I was in the grocery department, and the thing that frustrated me as a grocer in the grocery industry is that when you're a grocery store, you have to sell certain items that the store either loses money on or doesn't make anything on. Butter, eggs,
Mhm.
milk, peanut butter, Kraft Dinner, Cheese Whiz. There's a whole bunch of different items that as a store, you have to sell it because if you don't, people show up and they say, what kind of goofy store is this? It doesn't have
Yeah.
milk. And when you're Dollarama and you've only got 10,000 square feet versus a 40,000 square foot grocery store, you get to pick and choose what you list. And you say, look, if I'm not making a certain margin on this, I'm just not going to bring it in. The other thing that Dollarama can do is they can go to a vendor and they can say, listen, we've got 3 different kinds of dish soap in this store. One's going to be a generic brand, one is going to be a name, and two are going to be a name brand. Do you want to be one of the two name brand? And vendors eat that stuff up. They love it. They
Mm.
love that exclusivity. And in exchange for that, they will offer Dollarama a very attractive price to bring in the product. So you create a situation where you merchandise what you want and you can sell it for a good price compared to your competitors because you get these deals from the manufacturers. Then you have the Canadian dollar store industry where Dollarama dominates. I believe there's about 1,400 Dollaramas across Canada, and the
Man,
nearest
that's
competitor is Dollar Tree with like 150 or something.
wow. Oh my
Dollarama
God.
has essentially a monopoly on dollar stores in Canada. And unlike the US dollar stores, it doesn't matter what income level you're at, everyone shops at Dollarama.
Mm.
Where in the US, it's more heavily used by lower income individuals. So
Mm-hmm.
you combine all those things together and the quality is very, very high. Plus, Dollarama seems to post kind of 8 to 12% sales growth every year. They
They're
tend to open
killing
like
it.
50 stores a year. It's just very consistent, very good results over and over and over again. And the market loves that certainty and they will pay for it. But in 2018, Dollarama stumbled, and when they stumbled, they fell fast and they fell hard. So if you're thinking about Dollarama, be prepared about that.
That's literally the one. Oh, is that your cat? Oh my God, hello. Oh, he's so cute. He or she is so cute.
He, his name
He
is his name is Lenny, and he is a rat. I
he's
want everyone to
so
know
cute.
how he's a very bad boy. No, he's not. He's a good boy.
He's so
He
cute.
he,
How
he likes
old is he?
attention. He is 8.
Oh wow, okay, yeah, still a youngish cat. Yeah. I
Yeah,
had one
he's pretty
until
lazy.
he was 20. He lived that
That
low, which is long for a cat.
was
So
a
that
long time. Yep.
yeah, that was pretty cool. But yeah, Dollarama is maybe my favorite company, even maybe more than Brookfield. I never bought it because I couldn't get over the 30 times earnings, and
Mm-hmm.
I wasn't investing in 2018. I started in 2019. But if it fell back to that kind of level, I would buy like a lot because I have very heavy conviction in it also. Like you just described, the business model is it's not invincible, but as close as invincible as you can get probably. And everyone in Canada, we love it. I go to Dollarama all the time,
My
right?
wife drags me to Dollarama like it seems like weekly. Yeah, it's a wonderful business model, and it's the best retail company in Canada. I think by far, quality is very very good. And I'm normally not a it's like I really just try to find like, good companies. I'm not really looking to own like the best. I just want to own good companies that I think are steady and grow, et cetera. And but Dollarama
Is the best.
yeah, that's it. The quality is up there, and I like it. It's a wonderful company.
Yeah. I want to hear about you have a bunch of random obscure stocks that I'm sorry to say, but no one else I think ever knows or talks about. I just want to hear your elevator pitch on three of them. So it could be whichever ones you like, or three that I told you about earlier: Rogers Sugar, Grupo Aeroportuario, and Polaris Infrastructure. Like, what are those? What do they do? Why are they good?
Sure. So let's start with Roger Sugar. Roger Sugar is part of a sugar. Essentially, there's a duopoly in Canada. There's Rogers and there's Redpath. They sort of exist alongside each other. They both kind of have enough capacity that they can service their customers, have a little bit left over that gets exported. So the sugar business is incredibly steady. It kind of increases slowly every year with there's a little bit of inflation, but it's mostly just population growth. And the factories were built 50 years ago in some cases. They're very old factories, so they've long been paid off, and they just produce very consistent cash flows that I believe are quite safe. So Rogers pays out the vast majority of their earnings in dividends. I believe it's about a 7% yield.
Wow.
Today they've maintained that dividend for since 2011. They went from an income trust to a corporation, and they've maintained that dividend ever since. And then Rogers has also expanded into the maple syrup distribution
Ah,
business. So they make a lot of the private label maple
maple
syrup
syrup.
that ends
Okay.
up at the
Didn't know that.
grocery store. So there's not a lot of growth there. They're building an expansion on a plant that'll come online 2025 in Montreal. So there's a little bit of growth potential there, but it's not a lot of. It's just mostly steady cash flows. It's kind of like a quasi bond investment. I buy it when it's cheap, and I just sort of
Get the
hang on
dividend.
to it and just collect the dividend. It's like I said, it's like a bond. It's not. There's not a huge amount of growth there.
Mm-hmm.
What's the
Would you say,
next?
sorry, just quick question. Would you
Yeah.
say about this, is there a moat? Like, how's the industry? Are there other people doing this, or is it mostly them?
So there's a duopoly in Canada right now. There's a another company that is operating. It's called Sucro, and they're trying to use technology to sort of build more efficient
Technology.
sugar factories along the Great Lakes. And they picked the Great Lakes because they can easily transport it from like a Hamilton. They have a factory in Hamilton. They can transport it to New York, or they can transport it to
Oh,
Michigan, or very quickly, and then kind of sell it there. So it does give them a little bit more flexibility there. But Sucro, when I researched it, it seemed to me like they were mostly interested in the U.S. market,
okay.
and just using Canadian kind of labor and everything to sort of produce it in a slightly cheaper way, and then sell it into the U.S. because they have there's not as strong competition in the U.S. as there is in Canada.
Okay, interesting. All right, let's move on to the number two random obscure stock. But Grupo Aeroportuario. When I saw that in your portfolio, I was like, "What is that? Is that in Canada? Is that in Mexico? Where is
So
that?"
they so what happened in Mexico is the government owns the airports, and then they give companies the right to bid on these groups of airports to operate them. And so they sign 25-year agreements. And in exchange for that, they pay the government a fixed fee every year. And then the operators get to operate the airport. They have to make certain investments to keep it up to a certain standard. And basically, it injects capitalism into these airports while the government doesn't have to run them. They can just have these other guys run them. So there's three major airport companies in Mexico. There's Grupo Aeroporto, which Pacifico is the one that they have airports along the Pacific coast. So Tijuana, Puerto Vallarta, Guadalajara are their main airports. And then there's Grupo Centro, which has airports sort of down the central part of Mexico. And their big one is Monterrey. So depending on what you want to play, the Pacific ones are Mexican tourism, and I'm a bull on Mexican tourism over time. Puerto Vallarta is a wonderful place to visit. We go, I mean, not every year, but we go fairly regularly, and it's a great place. It's safe. The weather's beautiful. The beaches are great. It's reasonably cost, so on and so on. So I'm a big bull on that, and that's how I play it, is through that Pacifico. And then Centro is the play on Mexican industrialization. So essentially, you're taking manufacturing, you're moving it from China to Mexico for a number of reasons. We're closer allies, there's less political risk, the shipping costs are lower, so on and so on. And you're betting on that potential by sort of increase by buying the airport. And then two is it's a play on the Mexican middle class becoming wealthier and them traveling, whether it's domestically or internationally, which is a long-term growth driver as well.
Definitely going to happen. Very interesting. Okay, well, I learned something there. I'd never heard of this, but that's very cool. Okay, moving on to our third one, Polaris Infrastructure. This is the renewable in Nicaragua, right? Or is that another one?
So, this one is this one's a little friskier, and I'll explain right from the get-go. I have a small position in this, very small, because it's got some hair on it, but it's interesting. So they own, like you said, the renewable energy in Nicaragua. They have a geothermal plant there. They've been diversifying away from Nicaragua recently because there's the guy in charge is kind of a bad guy, and he's there's some locking up of dissidents and things like that, not the things you want to see, especially as an investor. So they're diversifying away from Nicaragua, and they've bought assets in like Panama and Peru and Ecuador, the Dominican Republic, and they're apparently close to another deal, which last conference call they kind of said, yeah, we're close to announcing something, but we haven't. So this one trades at, I think, about 5 to 6 times free cash flow. There's growth potential in terms of they have long-term power contracts signed with usually government-owned distribution companies that have inflation protection built in. They have the potential to develop more assets. In Dominican Republic, they're going to develop more solar powered assets, going to put some batteries in. So you have that growth potential, and then you have acquisition growth potential. So you put all that together, plus there's a big debt obligation that they have that it's been amortizing. So rather than a normal bond, which you just pay the interest on, they're paying principal back on this kind of every year, and they want to refinance it so they don't have to pay any principal back. So that'll add to free cash flow as well. So you combine all these things together, and there's a path for them to increase free cash flow 75% to 100% in the next 5 years, and it already trades at 5 to 6 times free cash flow. So it's very, very cheap, but there's a reason why it's very, very cheap. But in the meantime, they pay a very attractive dividend. I think it's about 6.5% in US dollars. So the dividend is safe. The dividend is a small percentage of free cash flow. It's cheap. The dividend is good, but Nicaragua is scary. And to a lesser extent, a lot of these other Latin American countries are scary too, because the region is somewhat tainted, with Panama has gone from a capitalist kind of friendly country to
not anymore.
With the copper mine.
Oh man, I'm a Franco shareholder. You think you own Franco too, right?
I own it too.
That I was like, are you guys kidding me? I cannot believe. No, I'm sorry. Do you read The Economist? Do you know that magazine? I read The Economist. They had an article about this where they said literally the money that they got from the mine accounted, I think it was like 60% of the national pension, like and I'm like, dude, are you guys insane? This is so much money that you are putting into the ground for no reason. Well, I mean, I know I get the environmental stuff, but even that, it wasn't what the protesters were depicting. I'm sorry, I know we're going off topic, but I still can't believe that stuff. It's crazy to me. Like that is just
I
yeah,
I agree that when you're sending a message to the world by going in this direction, and I understand there's political pressure and everything like that, but like you're sending a message to potential investors that their assets may be seized by the government, and that scares people
worst
for
message
very
ever.
obvious reasons. And that's the whole reason why Polaris is so cheap. So you got to kind of plug your nose a little bit and kind of go in there knowing that there's some risk. But the bad guy in Nicaragua, Daniel Ortega, has been in charge for as long as
Like 20
Polaris
years.
has owned that geothermal plant, and there hasn't really been a huge issue there. They've worked together. So it's been good so far, but all it takes is for him to get mad one day, and there's
Yeah,
some real issues.
and
So
in some trouble.
that's why I wanted to warn people. There's some warts on that one.
Yes, and of course, nothing is financial advice. Okay, I have four rapid fire questions for you, and then
Okay.
and then we'll be because I know this has been a very insightful chat. Nelson, I gotta ask you, why no Asia or Europe stocks or any other continent?
I've
What's wrong
got
with Asia?
uh, Well, I visited Asia a number of times. It's fantastic. It's a fascinating place. I love it. I have enough Asia exposure via companies like Manulife
Hmm.
um, that I'm comfortable with it. In terms of Asian markets specifically, I don't know Japan or South Korea well enough to invest there. I would consider it. China is a no go for me. I do not trust the government.
Hmm. What about Europe?
Europe is there are various kind of anti-capitalistic attitudes in Europe that make me a little bit nervous about investing there. Saying that, I have exposure. Intact Financial has operations in the UK. Great West Life has a big European division as well, and I owned for a time European residential
Oh, love
REIT,
that one.
which
Yes.
I've sold, but I had exposure in Europe there as well. Overall, I do want to get exposure to more parts of the world, and I will do that by sort of diversifying more and more into large multinational U.S. Stocks,
Like a Brookfield.
like a Brookfield.
Yeah. Okay. Why do you have so many holdings? And I can pair this with why do you not have ETFs? Would you just rather just have them all yourself?
Yeah. So if I were to the problem with dividend ETFs in Canada is they're largely market cap weighted. And so what happens is if you buy like a ZDV from BMO, is I believe like Royal Bank ends up being like 8% of the weighting, and you get like 50% of the weighting in something like 7 or 8 stocks.
Right.
And I don't want that level of um, concentration in, because it ends up being a concentrated bet on Canadian financials. And I think that Canada has wonderful banks, or insurance companies are good. It's just I don't want to have those types of weightings. The other thing is that I can avoid the ETF fees by doing it this way, and so that saves me 50 basis points a year, which adds up
Yeah.
over time. And two is I like the challenge of building my own portfolio, and I like that if something is down, it's beaten up, I can add to it and I can increase my weighting. And I think that overall, that will over time get me a higher rate of return than just straight buying the ETF and doing it passively.
Quick question for you. A follow up on that though. I
Mm-hmm.
like a lot what you said about the weightings getting all screwed up by the ETFs. But as a solution to that, What about something like an SCHD, which has it literally, makes it like 20% max per sector and 4% max per stock? Have you ever considered that one? And it's very cheap.
Sure. It is very cheap. The US dividend ETFs are certainly better than Canadian dividend ETFs. But for me, I want to have the majority of my assets in the Canadian stocks because when your only source of income is Canadian dividends, they are taxed
Ah,
incredibly
so
well
taxes. Okay, yes.
versus owning the US ones. But again, saying that, I do over time, I will diversify more into United States and other markets, but at the same time, it's like I'm not going to, 5 years from now, it's not going to be 80% US, 20%
Yeah, yeah,
Canada.
yeah.
It'll never be that
Right.
much. It's just kind of tweaking
Yes.
on the edges.
Got it. Okay. If I can just add one note for me, SCHD and just the US in general, I'm humble enough to say I don't think necessarily that I can beat the American market. Canadian maybe a little bit with some of my concentrated bets, but US no. So I'm very happy I have the S&P 500, which has done very well. And I really like having SCHD as well. And I use that one as a benchmark. So whenever I
Mm-hmm.
fall in love with an American stock, like I love Mondelez, they do the Oreo, or I love Coca-Cola,
Mm-hmm.
right? But then whenever I fall in love, I'm like, wait a second, how about does SCHD do better? And almost every time it does better. So I'm like, you know what? I just buy SCHD. And that's been a good rule of thumb for me just for the US, you know?
Like I said, the US dividend ETFs are much better than the Canadian ones. SCHD is if I were to go that route, it would be probably be the one that I would buy. It's a really good ETF. I would not fault anyone for buying it. In terms of outperforming in Canada, I really, it's not quite this simple, but if you take your portfolio in Canada and you avoid most oil companies and most
Yeah.
gold companies, you probably end up outperforming the TSX just by doing
Yes.
that.
Yeah, that's true. And
And
by buying less of a
sometimes,
field.
yeah, sometimes the TSX will kill you because like oil will do well or gold will do
Yeah.
well. But for the most part, if you just avoid those or if you stick to the very best oil companies or gold companies, like a Franco Nevada, which is the only gold company that I own. It's not even really a gold company; it's a financial
Yeah.
company that just uses gold as
Dabbles
the
in gold. Yes.
exactly.
That's
So,
true.
that's not that it's that easy. I'm the first to admit it, but um, that would be the first place I would start in Canada is avoid
Hmm.
those two sectors for the most part.
Okay, my final question for you for tonight. What was the best stock of all time that you've ever had? Like best return or your favorite, whichever one.
Um, that's a Dollarama is probably the one that I've made the largest kind of dollar amount on. In terms of my favorite or my favorite story or whatever, I'll tell the one that it's my favorite story because of the lesson that it taught me. And it was 2008. There's a company called Intertape Polymer, which made a lot of plastics and tapes. And one of their main products was the wrap that you put around houses before you put siding on them. And the housing market was blowing up and the stock got very, very cheap. And I bought in for a little over $2 a share. And then in 2011, I sold a bunch for 750 ish. And then in 2012, I sold the rest for $11 a share. And I was very, very happy with myself because of all this money I made and like, look how smart I am
Mhm.
and kind of forgot about the stock. And then in 2021, the company was taken private at $40.50 a share.
No, what? Oh
So
no.
um, I made the mistake of just saying, "Hey, I got a profit. I'm out," rather than looking at the company's fundamentals and everything. So I bring that up as a, "Hey, I made money and I did very well in a percentage gain perspective," but just goes to show how you should hold your winners. And when I look back at the mistakes I made as an investor over the years, the biggest mistakes I made came from not holding my winners long enough, and being too patient with my losers. So that's the lesson that I learned from that.
That's an amazing lesson. Thank you so much for sharing this, and thank you for taking the time for this whole conversation. I have to say for our listeners, this is, and you'll love this, this is the first time ever on this podcast that I am doing advertising, but I encourage everyone to become a paid subscriber to the Canadian Dividend Investing Newsletter. That's what it's called, right?
Yes,
Yes.
that's what it's called. Yeah.
It is an amazing newsletter. It goes right to your email. You have amazing articles. I read every single email that you send. That's why I remember when we first started talking, I was like, I want to study how you think for a couple of months just to understand you, right? The newsletter is amazing, and you post your portfolio in it, right? Which is where I saw that you have 10 million stocks. It's an amazing newsletter. I love it. So everyone, I highly encourage to do that. Yeah, thank you so much for your time. Really, really appreciate it. Oh, follow him on Twitter at CDI Newsletter, I think. Is that
correct?
it?
Yeah. Or if you just type in Canadian Dividend Investing, you'll find me.
That too. And follow his new podcast that just started, which is also Canadian Dividend Investing Podcast.
Yep. Yeah, it's on Spotify, Amazon, and Apple right now, and it'll soon be on YouTube once we start doing video episodes. And of course, we talked off the air, but if you if the listeners here tune in, they will see Anthony on there at some point. Because he's got to come on.
Yes. All right. So yeah, thank you everybody. Thank you, man, for being here. And yeah, thank you all for listening. And I look forward to connecting again with you soon.